This is Macro Horizons, episode 323, Art or the Deal, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of May 12th. And as investors await the results of this weekend's China trade talks, it's not wasted on us that CPI is released on Tuesday the 13th, setting up for a nightmare on Levy Street, perhaps. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market underwrote the refunding auctions with a reasonably good success record. The 10-year, perhaps the most important bellwether for demand, stopped through, and the market subsequently performed reasonably well. As a theme, the Treasury market remains contained within a known and relatively narrow range. This isn't to suggest that there wasn't in-range price action or that the curve was stable. In fact, it's fair to characterize the week as a choppy one, although the macro narrative appears to have stabilized, at least for the time being. The Fed statement showed very little change in the language, and Powell's tone at the press conference failed to err on the dovish side and was therefore, we'll argue rightfully, interpreted as hawkish and also lowered the probability of a rate cut in June or July. This is consistent with our take that the Fed's preferred timeline for resuming normalization would be to start with a 25 basis point cut in September and then deliver another 25 basis point cut in December for an aggregate of 50 basis points in 2026. Now, it goes without saying that the next Fed chair will be leaning more dovishly than Powell is, at least at the moment, and we'll argue that sets up the market for a minimum of 100 basis points in 2026, presumably spread out in 25 basis point increments, one delivered per quarter. Of course, this is all predicated on the assumption that the fallout from the trade war is contained to a few sectors and doesn't lead to excess demand destruction and therefore a material slowing of the real economy. Of course, this is a key unknown as we think about the balance of 2025, and perhaps one of the reasons that the market has been so content to trade the known range. We'll also make the observation that another key takeaway from the week just past was the absence of a buyer strike at the auctions. Well, we've been arguing that it's too early in the process to assume that the results from the trade war will be a scaling back in participation from overseas buyers of treasuries. Investors in the treasury market were, nonetheless, on guard for any evidence of a slowdown in buying interest. We also had an announcement from the White House that the UK and the US have reached a bilateral agreement on trade and tariffs. Now, the verdict is still out whether it was truly a comprehensive deal or simply a series of carve-outs and exemptions, but at the end of the day, the market took away a fair amount of optimism from the simple fact that a deal was reached. It will be interesting to see how the market interprets headlines from this weekend's trade talks between China and the U.S. In terms of the focal point of the trade war, it goes without saying that the relations between Washington, D.C. and Beijing will be key in setting the tone for the coming months.
Well, it was a big week in the Treasury market. We had May's long-end refunding series, 3s, 10s, and 30s, unchanged from last quarter, but nonetheless as new issue benchmark Treasury auctions, notable events for investors, especially given the current macro backdrop and the ongoing discussion around foreign appetite for Treasuries, the dollar's role in the global financial system, and how the trade war might be reshaping how global investors interact with the Treasury market, And then, of course, most importantly, was May's FOMC meeting where, to no one's surprise, policy rates were left unchanged. And frankly, the most impressive part of the Fed was just how little the language of the official statement was changed. The highlight was an acknowledgement that risks on both sides of the dual mandate have become more pronounced. And then Waller didn't dissent against the SOMA decision like he did last time because there was no SOMA decision. Otherwise, the side-by-side of the two statements were nearly identical, and Powell's press conference struck a similarly measured tone in that the Fed is in a hurry to do nothing.
And appropriately so. There's still not enough clarity as it relates to the global trade dynamic to suggest that the Fed should be normalizing rates or signaling that it won't normalize rates further this year. The reality is that we're still within Trump's 90-day pause on reciprocal tariffs. Now, that pause expires on the 8th of July. So there's plenty of time between now and early July for more bilateral trade deals to be reached and for the market and the Fed to have greater clarity and confidence on how the new trade order will unfold. It is worth highlighting that a deal between the UK and the US was reached, and while we'll reserve judgment on whether or not it was a good or comprehensive deal even, the reality is it does show progress on the trade front. While much has been said about the sheer number of bilateral agreements that need to be reached, the reality is that there are 5 or 6 that truly matter in the context of the magnitude of the trade deficit. China, Canada, Mexico, the UK, Japan, Vietnam. So we'll be eager to see over the course of the next several weeks how much progress is made on deals with those specific trade partners.
And we heard the observation made this week that there might be the potential for a similar version of what happened in the first Trump administration as it relates to the canceling of NAFTA, and in its place, the USMCA, that looked an awful lot like NAFTA did. Yes, some tweaks around specific goods here and there, but broadly speaking, the actual structural changes around the trade agreement between Canada, the US, and Mexico were not really all that dissimilar from what was in place before. Now, we're not suggesting that every trade deal that's going to be struck between the US and its various trading partners is going to look like a very similar version of what was in place before Liberation Day, but as has increasingly been the case, as positive trade negotiation headlines continue to hit the tape, there is at least this idea that the White House's aim in the original announcement of tariffs on Liberation Day was simply to catalyze the conversation with the U.S.'s trading partners and negotiate new deals that are not more favorable to the U.S. in the extreme, but rather a more measured retooling of trade terms that looks different from the prior paradigm, but not seismically so. And especially as we make our way through a UK trade deal, a Japan trade deal, a South Korea trade deal, there's certainly the potential for the market's focus to swing towards the other aspects of the administration's agenda: financial deregulation, a general deregulatory and pro-business theme, the potential for a pro-growth fiscal impulse, and all of the other factors that are traditionally associated with a Republican government. Now, will that be this week's story? Probably not, but especially as it relates to the Fed acknowledging the upside risks to inflation, it's something to consider this weekend as we learn more about the next trade deal and think about what that might mean for what's to come.
It is worth highlighting that we're getting to the point in the cycle where one should expect some of the initial tariffs to begin flowing through to the realized inflation data. April, however, isn't expected to see a material amount of upward pressure on core CPI as a result of tariffs. Nonetheless, the market will be on guard for any indication that core goods prices have biased the aggregate figures higher. We continue to focus on the period of May, June, and July as the most vulnerable for upward pressure on realized inflation related to the trade war. Now, it's important to keep in mind that Powell has gone out of his way to characterize tariff-related inflationary pressures as transitory. While we might not necessarily agree with bringing that particular word out of retirement, the sentiment nonetheless makes sense. More to the point, there's also a risk that higher prices at this point in the cycle function more as a tax on the consumer as opposed to risking triggering a wage inflation spiral that further delays the Fed's ability to resume normalization. Of course, the composition of any Sticky components of inflation will be key in determining the Fed's response or lack thereof. So we'll be watching the supercore measure, which is core services, ex OER and rent, for any indication that service prices have declined further in the wake of what we saw in March.
And on the topic of interpreting the data as things are changing so rapidly, there's also the case to be made that we've yet to see the impact of Liberation Day and the hit to business and consumer confidence that resulted from the big increase in tariffs. That's yet to come over the next month or two's worth of data, with CPI on Tuesday the most immediate example. But then there's the longer term side of this argument as well, which is that if we start to get some positive momentum, and assuming the labor market continues to hold up well, as it has, does that then run the risk that the bad data we're presumably going to be getting over the next several months will already be rendered stale by the fact that there could be some positive growth developments that happen in the interim? And so, while the Fed has been unwilling to react to the recessionary concerns that have been associated with the last month's worth of policy action out of Washington until the data is in hand, there's then this idea that they also might be reluctant to react dovishly to any bad data, given that it might be stale and we might see a reinflection in things like ISM services, consumer confidence, retail sales, which really all gets back to the challenge with monetary policy, which is that it's most akin to driving a car looking in the rearview mirror. But to say that setting the level of Fed funds and interpreting the data, given everything that's gone on in the global economy this year so far, is going to be a challenge would be an understatement.
And it's with that backdrop that the consolidation patterns that we're seeing in the Treasury market really do resonate, as the market appears to have found some degree of solace and equilibrium with 10-year yields between 4.25 and 4.50, chopping around in this range. The bigger drama appears to be playing out in the very front end of the curve, and that resonates. When we think of 2-year yields as nothing more than a 24-month rolling window of monetary policy expectations, the back and forth within the market between whether or not to price in a June cut or a July cut continues to drive relatively significant swings in 2-year rates and, therefore, the shape of the yield curve. Ultimately, we expect that once the FOMC resumes cutting rates and returns to the path of normalization, that the 2-year sector will price in even more forward rate cuts and 2-year yields will drift down toward 3% by the end of the year. However, there's a lot of uncertainty between current levels and 3% twos. That being said, we're still biased for a bull steepening, and as a theme, we like the steepener even in a scenario where the more dire potential economic outcomes from the trade war are averted. Ben, you made a very interesting point about how any downside in the economic data could be dismissed by the Fed as well. And that's very consistent with this divergence that we have seen between the soft economic data or the survey-based data and the hard or marquee economic data such as payrolls and final sales to domestic purchasers within the real GDP report. All of this, if nothing else, reinforces the prudence of the Fed's decision to wait and see. And that's been very consistent with the Fed's messaging. The recent array of official Fed rhetoric has only further reinforced this stance, a stance that we don't expect will change anytime soon.
And we've talked a lot about the Fed, we've talked a lot about the trade deals that may or may not be coming, but of course we got May's 10 and 30-year auctions, which despite all of the concern around de-dollarization and around a material lack of appetite for treasuries, both in the primary and secondary market, instead what we saw were results across the curve, although 30s were a bit on the softer side, but nonetheless the fact that the front end in the 3-year auction was well received, and then the 10-year auction, which we'll characterize as the benchmark measure of demand for treasuries at auctions, stopped well through pre-auction levels at effectively the low yield marks of the day, supports the idea that the latest backup we've seen in rates, back above 425 and closer to 450, represents an attractive enough level to bring in demand. And while we won't know with 100% certainty whether the majority of that demand came domestically or from abroad, for that we'll have to wait till the auction allocation data released on May 22nd, the results of the May refunding auctions were a welcome outcome for Secretary Bessent and those at the Treasury Department that continue to be tasked with funding the deficit. So a strong 10-year refunding is another detail on the list of factors that leave us a bit skeptical that everything that's happened since Trump took office means that no one wants treasuries anymore. At least this past week, buyers certainly showed up to the Treasury auctions.
And for any investor who might not have gotten the allocation that they wanted at the Treasury auction, don't worry, they'll make more. In the week ahead, the primary data focus will be April's CPI print. Here, we're expecting that headline CPI printed at 0.3% on a monthly basis, with core seen at a relatively benign 0.2. Now, obviously, within the details, we'll be looking for any evidence of upward pressure on goods inflation as a result of the tariffs. However, generally, the market isn't expecting that type of evidence to be on offer until the May or June data series. We'll also be watching the trajectory of OER and rent, which we anticipate will continue to moderate. Moreover, the volatility of the supercore measure, which is core services ex OER and rent, which recently printed as low as negative 0.24, will presumably offer monetary policymakers some solace given the high correlation between nominal wages and the supercore measure of inflation. Later in the week, we have PPI as well as import prices, which should help round out the market's expectations for core PCE, although the broader tone will be set by CPI. Let us not forget that we also see April's retail sales print on Thursday, which is expected to demonstrate the resilience of household consumption given all of the uncertainties that have been unfolding. The market will also be closely watching the initial jobless claims print, given the relevance of the trajectory of the labor market. There's an argument that we're long overdue for an increase in the unemployment rate. However, the fundamentals continue to suggest that the labor market remains resilient. We did have what was ostensibly a spike in the initial jobless claims recently. However, given the recent tendency for claims to be revised lower, it hasn't been particularly surprising to see the market resume the assumption that the employment landscape remains remarkably healthy, given everything that's going on in the real economy. We'll also be very eager to see March's tick data, which is released on the 16th of May. Now, it's unlikely to have a market impact if for no other reason than it's released on Friday afternoon at 4 p.m., but the reality is that the market remains very sensitive to any indication that there has been a shift in patterns of foreign buying. And while March's data might not be as current as one would like, it does incorporate at least the beginnings of the trade war. So within the report, we'll be looking at the details of flows from mainland China as well as Japan to see if, in fact, there was an acceleration, a deceleration, or no change in buying patterns from these two key regions. It's also notable that the week ahead has no nominal coupon auctions, which, all else being equal, should afford the market not only the opportunity to respond to the incoming data in a fairly clean manner, but also, all else being equal, consolidate in the current range, barring, of course, any dramatic headlines coming out of this weekend's trade talks with China or whatever else the administration has in store on the trade war front. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as April's inflation numbers come into focus, we remain impressed by Powell's word choice in characterizing tariff-related reflation pressures as transitory, although we probably would have gone with something more pedestrian like temporary. But then again, maybe that's why we're not leading the Fed. Well, that and the fact we're wholly unqualified.
Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.